So hello, everyone, and thank you for coming out this evening. Welcome to Social Security Explained. Before we begin, just one reminder, please hold all your questions until the end of the webinar. You can type your questions in the chat box during the presentation, and at the end, I'm just going to read all those questions out loud. So our speaker tonight is Mark Lange. Mark started his career as an intern developing computer models in the commodities market. He very quickly learned that this was not the area of his calling, as it did not offer the reward that helping others gave him. This desire led him to join American Express Financial Advisors. During his time at American Express, Mark completed the College of Financial Planning's CFP Professional Education Program and became a training and district manager. Mark then moved from American Express Financial Advisors to LPL Financial. He is a past member of Putnam Investments Gold Scale Council and Goldman Sachs Blue Chip Council, as well as a former host of From Wall Street to Main Street on radio station WTBQ in Warwick, New York. Without further ado, I'll turn things over to Mark.
Thank you so much. I think I have to get that little dissertation a whole lot shorter. After the number of years that I've been doing this, I think it's better when it's shorter rather than longer, but thank you so much for a warm welcoming. Tonight, we're going to talk about Social Security and the uniqueness of Social Security, because quite frankly, in most instances, this will be the linchpin of your planning as you start to do your retirement planning. So as always, I'm bringing this to you on behalf of SOFA. SOFA is the Society for Financial Awareness. It's a nonprofit organization that my partner and I had joined. Now it's almost 5 years ago. And we did it because we wanted to find a way to get back to all the people in our communities. And at this point, as I typically let people know, this is the first in what I call the financial curriculum of when it's time for you to plan for retirement. We typically start out with Social Security Explained. We'll then get into how to create a sustainable retirement income. We'll talk about asset allocation, risk management, and then ultimately estate planning. So thanks again to all of you for joining me. As I always say, I'd like to say thank you. For those of you who this is your first time joining me, this is not a sales pitch. That's not what I'm here for. I am here to educate you, and that is the primary reason for tonight's presentation. I'm hopeful that you'll get a lot out of it. If you have questions, please write them down so that at the end I can cover them for you. And as always, if you are interested, you get the opportunity for an hour consultation. If you'd like to do so, just reach out to me via my email. It's listed both in the beginning and at the end, and we can discuss your particular situation. You're entitled to an hour free consultation. So without further ado, let's get started. As I said, education only. If we were doing it live, we'd have some evaluation forms, which I love to get those back. But these are some of the key questions that I get anytime that I talk about Social Security. When can I take it?
I'm sorry, but your slides aren't changing on your screen.
Sorry. Oh. All right. We better now?
Perfect. Thank you.
Super. Sorry about that. Sometimes the mouse works on both monitors and sometimes it doesn't. Okay. So key questions that most people are going to ask. When can I take Social Security? If I take it early, does it go up when I hit my full retirement age, or what we call FRA? How do I maximize the benefits, not just for myself, but in many instances, as I say, this is the linchpin for retirement planning. How do you maximize those benefits for your spouse? Will this impact the other investment assets that I have? And if so, how does it impact it? Is Social Security going to be taxable for me? For some of you, it may not be taxable. For some of you, part of it may be taxable. And for some of you, all of it may be taxable. And then the last question that I almost always get is, how does Social Security work? How do we basically get dollars put into those different accounts? So I'm going to go through that with you. So let's hop in very quickly. The Social Security Act started in 1935. And basically, it established a social insurance so that we could prevent poverty in the United States. That was the primary objective. It was designed to be what? A supplemental retirement income. Let me repeat that. A supplemental retirement income, not the primary component of retirement income. Yet that is exactly what it has become. It was established also with the Board of Trustees for the Social Security Trust Funds, and they have to make an annual report on the status of Social Security. It also requires that annual report to go to Congress on the status of the funds. And as you can see in the yellow box, these are the Board of Trustees, which is the Secretary of Treasury, Labor, and Health and Human Services, as well as the Commissioner of Social Security, and now 2 publicly appointed representatives by the President that are confirmed by the Senate. So those are the folks who make up the board. And as I say, they're going to give you the status of how Social Security stands each and every single year. Now, I highlighted, as you can see in this circle, the two left components. These are the primary things that most people are concerned about. Why? Because very few people will ever qualify for disability benefits under Social Security, and the lump sum death benefit hasn't changed since it was initially instituted at $255. So you can imagine that doesn't go very far today. The two things that people are most inquisitive about are what we call the retirement benefits side and the survivor benefits. What is this program named? It's named OASDI technically, which is Old Age Survivors and Disability Insurance, or OASDI. So how do we finance it? Well, there's that little entry on your paycheck called FICA, which is the Federal Insurance Contributions Act, and wage earners and their employers make mandatory contributions for earnings up to an annual maximum or cap. There's a discussion that that may expand in the future, but it has not passed as of this point. So the cap for 2023 is $160,200. If you're self-employed, you're going to pay both the employee and the employer shares of FICA, okay? But you'll also get to deduct it off of your employer's share from taxable ordinary income. Those who have higher incomes are typically going to pay income taxes on a portion of their benefits, and a portion of that tax goes back to the Social Security Trust Fund, and also a portion goes to the Medicare Hospitalization Insurance Fund. So as you can see, there's a couple of pieces that come out to fund this. So who becomes eligible? Well, in order for you to become eligible for retirement benefits, you have to accumulate 40 total credits. You get 1 credit for each quarter that you earn $1,640 in 2023. In the past, it was lower, and it'll escalate each year with inflation. But for this year, you have to earn $1,640 in a quarter to earn a credit. So if you do that for 4 quarters, you'll earn 4 credits. So essentially 10 consecutive years of earning enough credits will do what? It will qualify you for retirement benefits under Social Security. Okay. So for 2023, the maximum amount that you have to earn is $6,560. And as long as you do that over those 4 quarters, you will earn 4 quarters worth of credits. What is full retirement age? Because for most people, they look at me and they go, what exactly does that mean, Mark? Well, today, and I'm going to talk about it from essentially the 1960 year and beyond. Okay. Prior to that, I'll get into the specifics of why I'm going to use that particular example. But today, if you were born in 1960 or later, your full retirement age is the age of 67. That's the age that an individual becomes eligible for full unreduced benefits. So if you're born in 1960 or later, it's going to be age 67. You can access those benefits, however, earlier than age 67. You can still access those benefits as early as age 62. Okay, but if you do so, you're going to get a reduced benefit. There's discussion that also in the future that access to early Social Security in the future will either be needs-based or you won't be able to get access to it. So this is another one of the changes that's on the horizon from a number of the different bills that are being introduced out there. So we'll have to see what the ultimate legislation looks like, but these are things that are being introduced currently. So for those of you, however, who were born before 1960, as you can see, there's different full retirement age timeframes. So for example, for me, I was born in 1959, so my full retirement age is 66 and 10 months. No, I cannot give you an explanation as to why they decided to do it this way. The only thing I can think of is they were probably sitting in the smoky room for too long and couldn't come up with any better ideas, because fundamentally it doesn't make a whole heck of a lot of sense unless you're trying to put together some sort of an actuarial equivalent, which is exactly what they've tried to do. But as we've seen with modern medicine, that continues to expand. So trying to put those things into play doesn't wind up being overly useful with regards to Social Security predictions for the future. So as you can see, if you were born in 1956, Your full retirement age, for example, would be 66 and 4 months. If you were born the same year as myself, 1959, it would be 66 and 10 months. So anytime within that gap of years from 43 to 1960, you have to check and see what your specific full retirement age is. The next question that most people ask me is, how do I know how much money I'm going to get from Social Security? Well, that's what we call the primary insurance amount, or the PIA. Okay. And most people say, well, how do you calculate that? Well, basically, it's on a sliding scale. So 90% of the first $1,115 of what we call average monthly earnings goes into this benefits calculation. Then 30% of the average above 1,115 up to 6,721. 32% of that goes into the calculation. And then 15% of the average monthly earnings over 6,721. For many of you who are living in the New York metropolitan area, you'll be at the top levels in terms of primary insurance amounts. How do we know that? We've looked at the Social Security statistics, and that's what it's proven out. If you live in the New York metropolitan area, you're basically New York, New Jersey, and Connecticut, you're basically within the top 10% of all those who are receiving Social Security benefits. But as I'm sure each and every one of you would agree, when you look at the maximum benefit that can be paid out by Social Security, it doesn't go a whole long way in these areas. So let's work through the calculations. So let's choose a baby boomer who was born in 1960. That means that they're turning 63 in 2023. They've been earning the maximum Social Security earnings every year since age 22. And that 160,000 has been on a sliding scale. So for example, if you go back into the 1980s, the maximum wage base was much, much lower back there because this has all been adjusted for inflation. So for example, back in those periods, you may be looking at wage bases someplace in the low to mid 20s. So you can see how it has just escalated on up with inflation over the years. So for 22 years, though, this individual earned the maximum Social Security earnings. So their average indexed monthly earnings, which is a compilation of all these components, is comprised of what? Here's the formula. So the first $1,115, we got 90% of it. Then they had the entire maximum in the next category, which was $5,606. We took 32% of that. And then the 15% was the differential between the end of that top bracket and the $12,318.20 that they had. So they are earning the maximum primary insurance amount for 2023, which is $3,627. It's a nice number, but I think most people would agree that if you're living in the New York metropolitan area, trying to live on basically that income level, low 40s, especially if you've got a husband and a wife, today in the New York metropolitan area is extremely difficult. So again, this was supposed to be a supplemental component, but it has turned into what? A primary component for most people. So let's look at what happens, however, because as I said before, many of you have the capability to access Social Security early, meaning before your full retirement age. So you can do it as early as age 60. So as you can see, and let's look at the three columns on the left-hand column, it has ages. On the middle column, it has earned benefits reduced to, and then on the right, the spousal benefit and what it gets reduced to. So for example, if you had a full retirement age of 67, which is the bottom left-hand number in this particular chart, you would get no reduction. You'd have 100% of your full retirement age benefits. And your spouse would be entitled to 50%, as we can easily see. But if you decide to take your Social Security earlier, you can see the corresponding reductions relative to the age that you choose to take it as an early benefit, not a full retirement age benefit, an early benefit. So you can see corresponding across those numbers, it's a pretty significant reduction across the board. So as you can see here, I kept an old chart. This was if your full retirement age was 66 versus 67. You can see the corresponding reduction in benefits if you decided to take them, for example, at age 62 through age 67, depending upon your full retirement age. So one of the things that I found interesting as I started to help people to really plan for retirement, I said, when do most people apply for Social Security? So here's the interesting statistics. For women applying for Social Security, as we can see, 61% claim Social Security early. For men applying for Social Security, we see that 57% claim Social Security early. What's the common element between both? They're taking Social Security before their full retirement ages. Now, here's the intriguing part of that. Your full retirement age benefit can increase by 8% for each year that you decide to delay taking your Social Security up until age 70, which I'm going to cover in just a moment. So considering the costs today and the impacts of inflation, 8% is one of the few elements that you A, can get a guarantee of, and B, it outpaces inflation and taxes combined. So it's something that I tell people you should seriously consider, especially if you have longevity that runs in your family or you don't have significant health issues as you begin retirement. You really want to be thinking about how you pass on the highest level of benefit in most instances to whom? Your spouse. And that's the most significant way to do it, delaying the reception of Social Security. By the way, we've also seen a very, very significant change in the strategies of when people take Social Security. These are historical data. If you look at the corresponding data to the last decade, what we're finding is that more and more people are doing what? They're delaying taking their Social Security until age 70 so they get the enhanced benefits. As I said before, if you were born in 1943 or later, for each year that you decide to delay your retirement and not take Social Security, you can get an additional 8% for each full year up to the age of 70, at which point there is no additional accrual with regards to that 8% benefit. Here's a key thing I want you to remember though. Application for Medicare is still recommended at age 62, especially for those of you who have employers that have greater than 20 employees. Yes, you don't have to join Medicare, but you still have to go and make decisions about Medicare at that point. So very important to file your applications for Medicare at age 67. As I said before, if you decide to delay taking your Social Security, let's look at the middle column here. If your full retirement age was age 66, you could have actually deferred for what? For 4 full years. So your payment would have gone from your full retirement age benefit to 132% of that if you were able to delay till age 70. For those of you who have a full retirement age of 67, do the same thing. Today, you'd only be able to get 124%, but that's still a very significant change. Why is that a significant change? Well, you'll see in just a moment. So, in many instances, when I talk about how much money are people going to receive in retirement, they really don't think about the magnitude of it. But this is just a $2,000 monthly benefit. And as you could see, the maximum benefit today is almost double that. So look at these numbers, folks. This was assuming a 2.6% annual cost of living adjustment, which, by the way, is the historical adjustment for inflation for Social Security, but certainly is not reflective of what we've seen over the last 2 years, which is almost a 15% adjustment in Social Security in just the last 2 years alone. So if we, though, take a step back and say, with a benefit that's almost double that, for many people, when we talk about husband and wife, it is not out of the realm of high probability anymore that we will see one of the two of you live for 30 years in retirement, in which case you could see a retirement benefit from Social Security of probably someplace in the neighborhood of $2 to $2.5 million inclusive of inflationary elements. So it's very important to make good decisions about how you're going to take your Social Security and when you're going to take it. Okay, what are the most important variables that go into that equation for you and your spouse? This is why I talked about the impacts of delaying Social Security. Based upon most recent projections from the trustees, without any reforms, benefits are predicted to fall to 79% in 2034. Folks, that's basically 10 years away. I can't imagine that Congress is going to take benefits away from seniors who have been using those benefits on an ongoing basis and depend upon them. I don't think that's where we'll see the adjustments. I think we'll see the adjustments in the ages that people are able to access Social Security into the future, especially early benefits. But I think you'll see a lot more coordination between the Social Security benefits and probably the required minimum distribution components as a result of those changes because of Secure Act 2.0 and the fact that people are living much, much longer. So I think that's how they'll address it. If they don't, for those of you who had decided to delay taking your retirement and accruing those additional benefits, what do you essentially wind up doing if this transpires? You'd go back to your full retirement age benefits, at least to a pretty close number from that standpoint. So as I tell people, very important, if you have the capability to delay the benefits, I would certainly do so, because these are not unknown variables. These have been in play for a long period of time. And really the determination of whether or not benefits will fall really has been a lot of conjecture between 2033 and 2035 over the last 3 or 4 years. So we know that there's a problem there, how they're going to deal with it. Again, as I say, this is what the trustees report says, but I think they'll come up with far more creative ways to deal with this situation in the future that will be more attuned to younger generations paying the cost, not the older generations. So here's some key questions that I always think about when I talk about Social Security. Is 2.6% an accurate long-term inflation rate moving forward? Well, we're 32, almost $33 trillion in debt at this point. We continue to see those payments escalating. There's a number of pieces of information that have come out over the last couple of months to substantiate that. So it's hard to believe that the historical 2.6% long-term inflation rate is going to be accurate. I suspect that we may see a similar period of time like we did in the 1970s, where we saw an average inflation rate for the entire decade closer to 5.5%, almost double what the current long-term inflation rate is. So Social Security is not going to keep full pace with inflation, but it's going to sure try to keep pace. The unfortunate side is that as inflation ratchets up your Social Security benefits, so it also does to the cost of Medicare insurance. So in many instances, we're not seeing substantive amounts of increases of the actual in the pocket dollars for seniors with regards to these Social Security increases from inflation. What is the probability that the baby boomer seniors will see a reduction in Social Security? As I said before, I don't think that's a reality. I think it's political suicide. Will the enhanced benefits go by the wayside with the expanding number of boomers coming onto the payroll? I don't think it will for the expanding numbers of boomers coming onto the payroll. But as I said, I think that you can see where the projections are going to be in terms of where Congress wants to go, which is pushing out the age that you can access Social Security and the other specific elements. They've already adjusted many of the very unique filing aspects that were available prior to the year 2015. They've basically eliminated all of those components so that there's not all these really interesting esoteric ways to access Social Security and get really significant benefits. They've basically eliminated all of that. What's the long-term prognosis of this system with our current debt level of 31 trillion? Sorry, I'm a little behind with regards to 31 trillion, but I think you can see they've got some really serious issues that they're going to have to deal with. And I think the most significant way that they'll deal with them is pushing out the age elements as we look further down the road. Okay, so this is where we are looking at things from the 2021 and 2022 perspectives. As you can see, the trust fund in 2023 and then the trust fund in 2021. It's slightly less in 2023 than it was in 2021, but we know that. We know that. We're starting to deplete this. So this is what the balance was as of 2019, $2.897 trillion right here. And we can see that we're slowly starting to eat into that. This is a known. For those of you who have never set up a profile on Social Security so you can actually see what your benefits are, the best way to do that is to go to www.ssa.gov. Okay, and you will need to set up your account and prove who you are. Now, as part of that, you're going to be asked some questions, some of which you may not have a really good memory of from years that have passed by. Do yourself a favor. If they ask you a question about a specific car loan or other element of credit, do yourself a favor and go back and check it. Don't guess, because if you make a mistake twice, you then have to go sit in the Social Security office to set up your account. I had 2 different loans when I was a kid, and I misquoted each one and had to go sit there for 3 hours to have them actually free me up so I could actually go in and see my Social Security components. So word of warning. Okay, so let's talk about some of the significant facts about Social Security. First and foremost, primary worker must have filed for benefits for a spouse to be able to apply for a spousal benefit. So if your primary worker that you're basing the benefits off of as a spouse does not file for benefits, you can't, as a spouse, file for benefits. If you're entitled to a spousal benefit and your own benefit, you're deemed to be filing for both now. Used to be you could actually basically break those 2 pieces apart, not anymore. Spouse must be at least 62 for reduced benefits or 66 for full benefits if 66 is your full retirement age. Only those who were age 62 in 2015 can use the grandfathered restricted application. I'm not going to get into that. If I do, I guarantee you that I will confuse everybody and you'll go, no, I can use it. No, you can't. There's very few people who can. They've typically already joined Social Security if they could. You get no delayed credits on spousal benefits after age 66 or your full retirement age. You don't get an increase in spousal benefits. Okay, you don't. File and suspend loophole was closed in 2016. So as you can see, a lot of those esoteric ways that people accessed more Social Security by doing some really good advanced planning, those are gone. Social Security is taking that away. Medicare. This is one of those things that people really don't pay a whole lot of attention to. But I always say to people, please pay attention to Medicare, because if you don't pay attention, mistakes here can be rather costly. Many of you who take early benefits forget to apply for Medicare because you're not reminded that this benefit doesn't start till age 65. If you delay Social Security till age 70, don't forget to apply for Medicare when you reach age 65, especially those of you who are working for companies where you have what? You have an ability to basically take a waiver with regards to Medicare now. You can continue to participate in your company plans if that's something that you wish to do so, but you still want to do your filings. If you defer your Social Security and you don't have company insurance, you can apply 3 months prior to the month of your 65th birthday. Because you're not enrolled in Social Security, you're not going to automatically be enrolled in Medicare. If you do apply for Social Security after turning 65 and your 7-month Medicare enrollment window is closed, you'll be entitled to enroll in the general enrollment that following beginning of the year, which is 1/1 to 3/31. However, benefits, if that happens, won't begin to be paid until July. And here's the real kicker. 10% penalty can be added to the Part B premium for each year you fail to sign up for the rest of your life. So if you fail to do it for 4 or 5 years, they could hit you with a 40 or 50% penalty. Have they done it? Not that I'm aware of, but leaving that latitude just scares the death out of me. So I wouldn't play games with that stuff. Who's eligible for survivor benefits? Well, dependents of deceased workers may be eligible for survivor benefits, and the number of required credits depends on the age of the worker at death. However, no more than 40 credits are required. So if you've earned those, if the deceased worker was employed for 1.5 years during the 3 prior years to his or her death, survivors could be eligible. So as you can see, the whole key to this is what? You've got to have 40 credits. Okay. Let's go through some rules for spousal benefits. Okay. As I said before, the primary worker has to have filed for their own benefits. The spouse has to be at least 62 to get a reduced benefit, okay, or full retirement age for the full benefit. So, for example, let's say we have a husband and wife, and let's say that the husband is older. So if the husband decides that he's going to delay till age 68, and he wants to get a slightly increased benefit, yet his spouse decides when he's 68, I would like to access Social Security, she's going to get a reduced benefit because she's taking it prior to her full retirement age. So she's going to get that reduced benefit on that primary insurance amount, even though if she had waited till her full retirement age, she'd be entitled to 50% primary insurance amount as a spousal benefit. No, as I said before, no delayed credits on spousal benefits after full retirement age. So if you're age 67 and you say, well, this is my full retirement age, but I'm going to wait till age 70. Does my spouse now get an increase in her 50%? No, you don't get any additional delayed credits for spousal benefits. Okay. Spousal benefit is based on the worker's primary insurance amount, not the actual benefit. I'm not going to get into a description of those two. I'll confuse everybody. Marriage requirements are you have to have been married for at least 1 year. And the most a spouse can receive as a spousal benefit is 50% of the primary insurance amount of the primary worker. So as you can see, this stuff is very clear and very straightforward. The difficulty for most people is that they don't deal with it all the time. So it sounds like a bunch of gobbledygook. And I can't blame any one of you if that's how you feel. So let's talk about how this works. So spousal benefit is equal to 1/2 of the primary worker's primary insurance amount if they started at full retirement age. So let's say that John's primary insurance amount is $2,000 and Jane's is $800. If Jane applies it for her full retirement age, her benefit's going to be $1,000, 50% of John's primary insurance amount. How did they get there? She'll get her $800 as a primary, and she'll get $200 of spousal benefit. And as you can see, if the spouse applies before full retirement age, their benefits are going to be reduced, as I said before. Key thing I tell everybody, anytime you're going to take benefits before full retirement age, you're going to have a reduction. Here's a quick summary of how this works. Let's look at the one on the left. If your full retirement age is age 66, okay, and we're going to use David as the primary insurance amount of $2,000 a month, which is the yellow highlighted bar on the chart. So age 66 is his full retirement age. He's entitled to $2,000 a month. Dana's benefit as a spousal benefit is entitled to $1,000 a month. However, if they both decided to claim at age 62, both would see their benefits reduced. If David decides to defer until age 70, his benefit goes up, but you can see here that spousal benefit did not grow in a corresponding manner. It did not increase beyond what the full retirement age primary insurance amount was. Okay, so important to remember that. But here's the key thing to think about. As a result of David having deferred taking his Social Security until age 70, if David then passes away, his spouse now has the opportunity to take his Social Security benefit as a survivorship benefit. And that's very significant when we talk about planning for income, when one of those two spouses has predeceased the other. And now all of a sudden, we really need to start to think about what are the costs that that remaining spouse is going to have, and what are the sources of income to support that. So let's talk about some of the rules for survivor benefits. First of all, a couple must have been married at least 9 months at the date of death, except for the case of an accident. The survivor must be at least 60 for reduced benefits. 50 if they were disabled, or full retirement age if they want full benefits. Survivor benefits not available if the widow remarries before age 60 or 50 for disabled, unless that marriage ends. This is why in so many instances we're seeing seniors who enjoy the companionship of other mates living together, but they don't get remarried, because otherwise it would have a significant impact on their Social Security benefits in many instances. And divorced spousal survivor benefits are available if the marriage lasts at least 10 years. And it doesn't have any implication on the other survivors. So let me give you an example. I call this the Johnny Carson rule. Johnny was married 3 times to 3 different wives, and each one of those marriages lasted at least 10 years. So each of those surviving spouses was entitled to his full benefit. Johnny had waited till age 70 to take Social Security benefit. They would all be entitled to those enhanced survivorship benefits. None of the other ones would have any impact on their ability to collect as a survivor benefit. So very significant, these survivor benefits and how they and the types of implications that they have on the planning that you do in the future. So again, when we talk about these survivorship benefits, it's going to depend on, first, the age at which the deceased spouse originally claimed his or her benefit, what we call the original benefit. And if he claimed before his full retirement age, the survivor benefit's going to be limited to the higher of the deceased spouse's benefit, or what they call their 82.5% floor. Folks, I'm not going to get into a deep discussion of this. Again, I'll confuse the hell out of you. If he claimed after his full retirement age, the survivor benefit will include the delayed credits. The age at which the widow claims the survivor benefit, what we call the actual benefit, if she claims before her full retirement age, her survivor benefit is going to be a fraction of the original benefit. Again, it's going to be reduced. If she claims at her full retirement age or later, her survivor benefit is going to equal 100% of the original benefit. So as you can see, we've got a couple of different places where you really have to kind of plug yourself in if these situations occur, and then look at the optionality that's available to you so that you make the best decisions moving forward. Okay, so let's work through one of the survivor benefit calculations. So if the spouse dies while both are receiving benefits, the widow or widower may switch to the higher benefit. So in this instance, Joe and Julie are married. Both are over full retirement age. Joe's benefit's $2,000. Julie's is $1,200. Joe passes away. Julie notifies Social Security, and her $1,200 benefit is replaced by her $2,000 a month survivor benefit. And they do that very quickly. Now, here's an example. If early claiming was utilized, again, Joe and Julie are married. Primary insurance amounts $2,000. Joe files for Social Security at 62. So his benefit's going to be 3/4 of the $2,000 or $1,500. If he dies, Julie's survivor benefit will depend on when she claims it. Again, if she claims a survivor benefit at 66 or later, her benefit's going to be 82.5% of Joe's PIA. This is the special floor for benefits. Or if she claims her survivor benefit at age 60, her benefit's going to be reduced even further. So very important to pay attention to these things from a survivorship standpoint to determine when it's best to do your claiming. Okay. For survivorship benefits example, using the delayed claiming strategy, again, same 2 people. His primary insurance amount was $2,000, but he waited till age 70. And in this instance, because his primary insurance or full retirement age was age 66, he got 4 full years at 8%. So he got a 32% increase, took his benefit from $2,000 to $2,640. He passes away. Julie's survivor benefit will be equal to Joe's $2,640. If she claims her benefit at age 60, she could do it early. Her benefit would be severely reduced. But if she waits till her full retirement age of 66 or later, her benefit will be his full amount, the $2,640. So as you can see, survivorship planning really becomes a key component for husband and wives, especially when Social Security is such a critical issue from a cash flow standpoint. Are non-workers eligible for survivor benefits? Well, sure they are. I just told you that spousal benefits are absolutely available to non-working spouses, but you also have survivorship benefits. So many non-workers, such as widowed individuals, unmarried children, and dependent parents, can qualify. There's a whole bunch of different hoops that you have to kind of hop through in order to qualify for those benefits. So we won't get into those tonight. Are non-workers eligible for Social Security benefits? Yes. At one point, there was 122 different tentacles that you could actually pull on to access Social Security. They have since severely reduced that, but there's still quite a number. Widowed individuals are eligible for unreduced benefits at full retirement age, reduced benefits at age 60 or 50 if they were disabled. Widowed individuals supporting children younger than 16 years of age or disabled are eligible. Unmarried children younger than 18 years of age, 19 if they're full-time students, are eligible. And if the deceased worker provided more than 50% of the support for workers' parents, are eligible at 62 years of age for benefits as well. So as you can see, there's quite a few different ways. Rules for divorced spousal benefits. So more than one ex-spouse can receive benefits on the same worker's record, as I like to call it. It's the Johnny Carson rule. Benefits paid to one ex-spouse do not affect those paid to the workers and the current spouse or any other ex-spouses. Divorced spousal benefits stop upon remarriage of the spouse collecting benefits, not upon remarriage of the primary worker. Very important to remember that. Divorced spousal benefits. Your marriage has to have lasted at least 10 years or more. The person receiving the divorced spousal benefit is currently unmarried. The ex-spouse is at least age 62. Again, have to have filed for the primary benefit. If divorce was more than 2 years ago, ex-spouse does not need to have filed for benefits. It's more than 2 years. So now the key question that many people are going to ask me is, how much are benefits going to be taxed? And it really depends upon your filing status and your income level, period. Those are the things that go into the equation. So let's talk about them. On the left-hand side, you can see the individual. On the right-hand side, you can see the joint. And as you can see, I'm going to use the joint because most instances I'm talking to couples about their planning. Combined income between 32 and 44,000, up to 50% of your benefits are taxable. And if your combined income is more than 44,000 in retirement, up to 85% of your benefits are taxable. So for most people who live in the New York metropolitan area, where do you fall? That's right. You fall in the joint category over 44K, so 85% of your benefits are going to become taxable. Some people will say, well, I would like to continue to work. What impacts are there on my Social Security benefits? Am I going to see a reduction? Well, there's 3 specific elements to deal with this. If you begin collecting before your full retirement age and you continue to work, if your full retirement age is not reached during that entire year, they'll deduct $1 from benefit payments for every $2 you earn above the annual limit, which, by the way, is not very high. It's about 18K. If your full retirement age is going to be reached during that year, they'll deduct $1 of benefits for every $3 that you earn, but only on earnings before the month your full retirement age is reached. And then if you decide that you're going to continue to work beginning the month your full retirement age is reached, there's no limit on the earnings. Just determines at that point how much your Social Security is going to be taxable. So what are some key things to consider? Only apply for one benefit at a time. Do not file for both simultaneously. Why? Very difficult to do so unless it's a spousal type benefit. In most instances, it pays to compare your own benefit against a survivor benefit to determine the strategy that will generate the most money long term. This is why in many instances, when we have a primary income earner that has a higher or a substantially higher benefit and a potential to make it a much, much higher benefit, especially for the receiving widow or widower, it's very important to think about how to maximize that benefit, because not only will they lose at least half of that income, but you want to try and maximize the bigger of those 2 benefits. As it says here, in most instances, it is beneficial to take the lower earning spouse's benefit first and defer the high earners benefit until age 70. This strategy locks in the biggest benefit for that surviving spouse, and that in most instances is going to be your primary concern. And then the last piece here, could a Roth IRA impact how my Social Security is taxed? It can, but it depends upon how you utilize that strategy. So this kind of brings us back full circle for many people. And it begs the question, when should I take Social Security? Well, that's going to depend on you. And it's going to be based upon your needs as well as your probable life expectancy. So if you've got health issues, you're probably going to access Social Security sooner rather than later. If longevity runs in your family, you're probably going to access it later rather than sooner. Healthy individuals typically delay benefits. Delaying those benefits likely increases future benefits for a younger spouse as well. And less healthy individuals, as I said, typically begin receiving them at age 62. They typically need to turn on the tap. And the other big component that also accesses Social Security are the people who get what we call RIFT, reduction in force. They're let go. They were planning on continuing to work and adding additional dollars into their retirement components, and now all of a sudden the whole situation has changed. So Social Security, as I say to most people, should really begin to be planned for at age 60, no later than that. And you should run multiple scenarios to see what it means if you had to take it sooner, if you had to take it at full retirement age, and if you're able to delay. Very important to look at that optionality. So when we talk about retirement planning, these are the three choices you're going to have. You're either going to take it early, you're going to take it at full retirement age, or you're going to delay it. That's it in a nutshell. These are the three primary sources of what we'll call guaranteed income in retirement. So Security defined benefit, pension plans, and annuities. Why do we talk about guaranteed sources of income? Because what we found is that for most people, for example, who have defined contribution plans, of which the majority are held today, it used to be in the 1930s, 40s, 50s, and even 60s, it was predominantly defined benefit or pension plans. They're very rare today. Most are defined contribution plans. What we found is that most people are very poor risk managers during the distribution phase, when you really need to have professional guidance and true risk management. It is imperative that you do that. These are the primary sources that you're going to find that will give you that capability. So why do we talk about annuities in many instances? Because you're going to get lifetime income options, which allows you to do what? Continue to take a payout and stay, in many instances, invested the way that you're supposed to. Also, you can protect death benefits for your beneficiaries if you need to do so. So very important to think about those planning aspects. So what are the next steps for everybody here? Get familiar with Social Security. Go get your statement online. Sign up, www.ssa.gov. Get set up in your account and see what your numbers look like. The other thing that you want to do is make sure that the crediting to your account is the income that you expected it to be. I had a client who was missing 5 years, and yet they had all their tax returns, so they finally got Social Security to recognize it. You can imagine how much of a difference that made in terms of the benefit. Understand how the primary insurance amount is impacted by earlier delayed retirement, earned income, as well as taxes. And then consider some financial products such as annuities and things of that ilk to help you bridge the gap. Now, as many of you will note, as a result of Secure Act 2.0, actually Secure Act 1.0 required that defined contribution plans at least give you an annual projection if you were to annuitize your retirement balances. There's discussion that you may be forced to annuitize at least a portion of those balances in the future. Why? To guard against you blowing up your own assets. Trust me, folks, it's out there and it's being discussed. You will not have the ability to control your 401k. Eventually, as time goes on, they may force you to do what they want you to do, which is to annuitize a sizable portion so that you don't blow it up. That's how significant the problem is. If you're not familiar with how to do this stuff, contact a financial advisor and determine the optimal strategy so that you can get things set up properly. As I said before, I thank all of you when you spend time and come and join me for an evening. Normally, I would ask you for an evaluation form, but let me just remind you, if you have questions, please reach out to me via email. As I always tell people when I do my presentations, people will say to me, do you take on new clients, Mark? And I tell people, rarely do I ever take on new clients. I've been in this business for a very long period of time, and I enjoy giving back and helping you to do the planning for the future. So if you have questions, you're entitled to that free consultation from SOFA. Reach out to me via email, and I'll be more than happy to set up that time with you. At this point, why don't we open it up so that we can see if we've got some questions.
Excellent. Thank you so much. So I know that we had at least one question in the chat box. I'm 56. I have worked 42 years. I have 5 illnesses. What age can I retire and how much money will I receive?
It's going to be based upon what your work record is. So the way that Social Security works is they will take the 35 highest years of earnings that you have to create your primary insurance amount. As you saw from the calculation that I showed you during the presentation, all those income dollars that come in will help to determine just exactly what that average indexed monthly amount is for you. Then the question becomes, when can you access it? Well, if you've got the 40 credits, you'll be able to access it at age 62. That's when you can claim for early, unless you're permanently disabled, in which case I would reach out to Social Security sooner. In that case, you're actually probably going to try and get Social Security disability income. As I said before, that's very difficult to be able to get that, but I would reach out to Social Security if you've got that many variables in the equation, see if some of the exceptions potentially fit for you.
Awesome. Thank you. The next question, would you put your contact information up on the screen?
Sure. You've got my email. It's mark.lange@lpl.com. If you want to reach out to my website, it's prudentfa.com. Those are the 2 easiest ways to reach me. You can reach me via the website, or you can reach me via email. That's usually the easiest way to get a hold of me.
Excellent. Thank you. We don't currently have, oh no, here's more questions coming in.
Sure.
Excellent. How does the government define entitlements? It seems that Social Security is considered a gift, not something that has been paid into.
Well, if you look at how Social Security was structured, it's basically the workers of today support the retirees of today. So a great deal of it was based upon what we'll call actuarial assumptions. Those assumptions made predictions as to how fast would our population grow, what would incomes escalate to as a result of inflation. So as you can imagine, trying to predict the successfulness of this type of a program 30, 40, 50, 100 years out would really be doing a heck of a lot of geometry and trigonometry and calculus all combined to come up with a very, very accurate number. But I think the problems that we've seen is that we didn't anticipate, for example, that baby boomers were going to live as long as they live today. That's number one. We also look back at Social Security and we look at the magnitude of ways that people could access Social Security early on, which really wasn't within the spirit of what it was designed to do. So unfortunately, that caused a lot of the problems that we've seen. And now, as a result of longevity going even further and further out, and baby boomers being a gigantic component, that's really going to put a lot of stress on it. That's why you're seeing Social Security having the trouble that it's having. And we have not seen the workforce growing fast enough and getting a wage element that's high enough to make Social Security solvent today. So typically they'll come up with one of 2 solutions. One would be to increase the tax base to support that, or when you see situations like this where you can utilize the longevity curve to your advantage, you will push the age out before people can actually access those benefits. That's why I don't think that this sacred cow will be touched anytime soon, even going into that 2034 when it's expected that it's going to see some significant reductions.
Excellent. Thank you. The next question, how does getting Social Security disability at a young age affect your Social Security when you have reached retirement age?
You'll basically continue it if it's a permanent disability. But I will tell you this, it's extremely difficult to get Social Security. My nephew had a very serious accident where his arm was completely severed from his body, and they were able to reattach it, and it doesn't fully function. He still doesn't, it doesn't have the ability to access Social Security for permanent disability. So as I tell people, it has to be something that you cannot be gainfully employed to do, of which, let me tell you, the bar for that is pretty low. So trying to get Social Security disability is very, very difficult.
Excellent. Thank you. The next question is actually a question for me. Will a copy of this presentation be sent to everyone here? There was a lot of information to absorb, and being able to go back and reference the presentation will be helpful. We are recording this presentation, and it will be available on the library's YouTube channel, probably at the end of this week or the beginning of next week. So if you just go to the library's YouTube channel at that time, you'll be able to rewatch this presentation anytime.
My apologies as well. As I often say to the librarians, and thank you so much for making that available. I typically try to feed people with a fire hose. I only get a limited amount of time to give you as much information as I can. I deal with this on a regular basis, so it's something that's very comfortable and for me to talk about, but I can certainly recognize for folks that are not dealing with it on a regular basis, or it's new, you probably have some significant questions. So as I say, the presentation, seeing it again will help, but if you have specific questions, reach out to me.
Excellent. Thank you. I don't see any other questions, so I'm going to give it just a minute or two. And again, if anyone has any questions, please type them into the chat box, and I'll be happy to read those questions out loud. I'm just going to go over the chat box really quickly while we wait to make sure I didn't skip anyone's question, which is always a danger. It doesn't look like I skipped anyone's question, so I'm going to give it just a minute just to see if anyone else has any additional questions for the presentation.
So I'll just kind of give all your listeners an idea. As I say, this is part of what I call the core curriculum. So I think of it kind of like when we were going to school or in college. And I start the first one out with Social Security so that you get an understanding of the key linchpin, then how to create that sustainable retirement income and the issues that are involved with that, and then some asset allocation, and we'll talk about risk management. And obviously those paradigms shift quite a bit depending upon where we are in market cycles. And then ultimately the estate planning element, where we'll go through the foundational elements that really need to be created for you to have something that you would feel comfortable with from an estate plan that at least covers the vast majority of the key elements that people are going to talk to both myself and the estate practitioners on what they want to do to dispose of their particular estate on down to their heirs.
Excellent. I do have one last request for your email address again. So that's,
sure.
I believe it's mark.lange at
lpl.com.
lpl.com. I'm just going to put that in the chat for everyone.
Perfect.
So that everyone can have it available. They can write it down.
Oh, sorry. I'm behind on my on the mouse again.
No worries. So now it's both in the chat and on the screen for everyone. And I don't see any other questions in the chat box. So I want to say a big thank you to everyone for coming out tonight and attending this presentation. We always appreciate it. And a big thank you as well to Mark, who donates his time to come every other month and do these financial webinars for us. So thank you, Mark.
My pleasure. Always glad to be with you.
Excellent. Thank you so much. I hope everyone had a great evening, and I'll say goodbye to everyone. Thank you.
Thank you.
Night.
Good night.
Good night.